So we manage both institutional mandates in Singapore dollar bonds and also ETFs in Singapore dollar bonds, managing government bonds and corporate bonds. So I think the advantage for local investors, they would prefer not dealing with the currency volatility. One, if they do have to invest in US dollar bonds, the hedging cost is quite high. So in the end, if they can invest in Singapore dollar bonds locally, they would. And so what we're seeing are local investors buying Singapore dollar bond funds or having an allocation separately on Singapore dollar bonds. For retail bonds like the ETFs, we continue to see inflows on a steady basis. And we've seen our fund growing quite steadily. And so what you can see in this bond market is very well supported. The bond market is yield-based. If in case there's rates rising, recently since the Fed cut in September, rates were rising like 50 to 60 basis points in the US. Singapore dollar bonds hasn't raise yields as much as that. So I think it's the lower volatility of Singapore dollar bonds in general attracts local investors. It doesn't sell off because of US fiscal risk, because Singapore dollar bonds are issued not for fiscal reasons, but really to develop the bond market. There's strong technical demand. Investors are yield-based. They don't sell off quite as volatile as even the Asia credit dollar bond market. If you compare the volatility, Jackie IG, SGD hedge, volatility is about 5 to 6% in the last 3 years, while Singapore dollar investment grade is only 3 to 4%. That speaks for the lower volatility of local currency bonds. I think it might be true in other local currency bond markets. So also I think that's where investors are heading, is that the local currency bond markets would be a preference for local investors.